Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. It is Monday morning, October 10th, and the Treasury market is closed, but we have a market today that is going to start to focus on, again, inflation. What went wrong last week? Well, what went wrong last week was we had a fairly decent report coming out of for the labor market. This is a strong labor market. It is resilient. And for the Fed, that is not what, they want to see. They want to see wages come down. Fortunately, wages are leveling off, but the worry is that the strength of this labor market can continue to feed, ultimately, higher wages, and that, again, goes into higher prices. This is the major concern about it, is the wage price spiral. Good news, however, if you want to look at it that way, is that the job openings are beginning to ease, and we lost about 1 million jobs. What's happening is that companies are just basically not going out and hiring more. The Fed wants to see much more of that. They have made it very clear that what they are looking for, if they could plan it accordingly, is for the job openings to decrease much more. And then what that does is it says to people who want to quit their jobs and go get another job for higher wages, which, by the way, happens to be the leading cause of why people quit. It is, well, I'm going to quit and then I'll get another job that pays me more. And this is what we're seeing. The Fed wants to break that because they want to bring down those higher wages. Pure and simple. It sounds horrible to say this, but that is what they want. And they have preferred, as they have said so many times when you hear them speak, is that's the path that they would prefer. Get the job openings to come down so that you don't have to kill the labor market. When I say kill the labor market, you've heard them say pain. We may have to induce pain in order to get those wages down. But if you could do it by decreasing the number of jobs that are open, it means that the worker has less leverage to get higher wages. So that's the point. And that just got the market, as you saw that, got the market like, oh my God, it became good news, became really bad news very, very quickly. This week, what we have is a week of earnings, finally. And this, I just want to say this as an aside. I noticed when I started working, working in New York. I started working on the trading floor for my mentors were the traders. But one of the things they would always say that happens to be so true is that the market develops obsessions, right? Obsessions. And then, just as you've kind of noticed the obsessions and get into it and follow it, the market changes course and comes up with another concern. And then you got to go into that one. And you're like, why did they drop that? I was just beginning to understand that obsession. Well, right now, the market's obsession is they want to see the news turn bad so that they can translate that through the Fed's eyes, and hoping that the Fed eases up on its campaign to thwart inflation. With 75 basis points, it's pretty tight. Financial conditions are tightening, and the market conditions are moving into restrictive territory. That's how we say that. Because at the same time, just to repeat, the Fed is not only raising rates, they have increased the quantitative tightening program. That is to say, winding down their $8.9 trillion balance sheet, winding down, taking away $95 billion a month of mortgage-backed securities and treasuries. That also leads to more tightening. It doesn't come out as, 5 basis points, 75 basis points, 50 basis points. No, but it is a form of tightening. And the question really is for the Fed and the market is how much tightening does it add to what the Fed is doing with interest rate hikes? We will find out, obviously, as the Fed continues quantitative tightening. So this week, there is another week of Fed speakers, one after another, and tomorrow we're going to have the beginning of the economic data releases because the federal government is closed with it, and obviously the data releases aren't coming out. We're going to have the National Association of Small Business Owners. I pay very close attention to what they say. I see them as the backbone of our country. They are on the ground, so to speak, granular. They know what's going on. And one thing we heard from last month's report, which was looking at August data, because it came out in September, looking at August data, was that the survey said that a majority of the small independent business owners said that inflation was moderating. Very, very important, because once we see the folks on the ground that work in industries all over the country, many different kinds of industries, service sector, manufacturing, that will be important for the perception of whether or not inflation is moving downward at a faster clip, which is what the market is looking for. Also this week, we are going to have the Producer Price Index, the PPI. And what this is, it's the pipeline of prices for manufacturing, essentially. And we'll see whether or not that continues to ease too. And then, obviously, it is the Consumer Price Index that we're going to get, the CPI. And for the Fed, what they will be focused on is rents, which are about 30% of the Consumer Price Index core. It is coming down. The reports indicate that it's coming down. The question is it fast enough? Is it fast enough for the market to believe the Fed will be prepared to go from 75 basis points and ease up a bit and go to 50? And also, they are also looking at the headline. And this is interesting because the Fed doesn't usually make comments about the headline. But you've noticed they're talking about energy prices, right? And they're talking about food prices, because they will always mention we're concerned about the low wage earner having to pay more for transportation, to pay more at food markets. So a lot for the market to digest, but overall, we will watch to see whether or not the Fed funds futures market changes from 75 basis points for the November 2nd meeting and perhaps moves to 50 basis points. It's going to be in a very important week. This week, too, the official opening of the earnings season. And I can't stress this enough. There is pessimism going in, many analysts saying, we haven't seen enough downgrades, we haven't seen enough of lower estimates, that needs to be done. Well, we will find out. This week we're going to start off with some of the important names in the semiconductor sector. Taiwan Semiconductor. This is going to be extremely important because demand is coming down based on the reports that we are seeing. We want to see if there's a turnaround. One thing about the semiconductor, the chips, is they send an important signal on the way down when you start seeing it turn, and on the way up. Even a little bit of less bad news will matter. So we want to hear what they have to say. Also, this week we're going to hear from Delta Airlines. Very important because travel costs had moved up pretty handily in the summer. Let's see what they say about it moving back down. And then also we'll hear from Domino's. Clearly, America likes pizza, but their costs have been going up. They're paying more for cheese, more for tomato sauce, you name it. And also their drivers, paying more at the gasoline pump. We will see what they have to say, whether America still loves pizza, but at what cost to the pizza makers. This week, too, at the end of the week, we are going to hear from a variety of banks. Everything from JP Morgan to Citi to PNC, Wells Fargo, across the board. Extremely important because what we will hear from them, and remember what this is all about, it's about the guidance. What are they seeing? What do their customers say? What do their clients say? and we will get a sense of loan growth, whether they are looking at defaults, whether they are looking at more loan interest from companies, and also in terms of mortgages, are they seeing delayed payments? And also about credit cards. One of the things we will hear from the companies that have the credit cards, for example, JP Morgan Chase, is who's using the cards more? What are they using it for? What we heard the last second quarter earnings season was this, that lower wage earners were using their credit cards more to pay basic necessities, whereas they saw the upper income consumers and wage earners using it for going out, using it for trips, and so on. So it's going to be interesting to see if we see any shift whatsoever. I do want to mention, too, that BlackRock is reporting this week, and that's going to be very important because they will give us a sense of what they're seeing based on all of their broad, very, very broad selection of products and what they see going ahead, whether it's the fixed income and equity markets, emerging markets. It will be very interesting to hear what they have to say. Also, in addition to all of this, at the end of the week, also on Friday, we will get the University of Michigan Consumer Sentiment Report. This will not capture OPEC's announcement that they are cutting production, and I will get to that in a second. But it will capture how the consumer feels, because consumers have actually been feeling quite a bit better than they did in the beginning of the summer when gasoline prices were rising dramatically. Also, we will see what the consumers are saying about inflation over a 5-year period. That has come down, and that's important for the Fed, because when consumer expectations for inflation climb over a 5-year period, it's telling you that their expectations could become entrenched, which is very hard for the central bank to break. Fortunately, consumer expectations did start to come down below 3% when gasoline prices started to come down as well. So that brings me to what the expectations are in this earnings season. Well, going into it, we expect to see year over year, third quarter, about 2.4% growth in earnings year over year. So last year to this year. That's down, by the way, from the second quarter earnings, where it was just over 6% year over year. You know what? Ultimately, there are going to be adjustments as we get through the earnings season. There will be positive surprises, which will be very good for a market that is really worried about whether or not we are headed into a recession. So I can't stress enough how important guidance is during this earnings season. Extremely important for the market to ascertain whether or not a recession is a done deal. So keep that in mind. There's a tug of war in the market with many pretty pragmatic analysts saying, you know what, maybe if we do go into recession, it'll be shallow, versus those who are coming out in the press, oh no, it's going to be deeper and deeper. And on top of it, that the Fed is going to keep going until it breaks something, right? So when OPEC came out with their production cut announcement, which was 2 million barrels of oil a day in cut. Keep in mind something very important, and that is it will probably not manifest itself. And the reason is that most of the cartel, they don't have the supply in order to cut, okay? They just don't have the supply. The Saudis do. The UAE does, but basically overall, that big cut will probably be in real life maybe down to about 10% cut. No sooner had that come out than the administration announced that they would take 10 million barrels out of the Strategic Petroleum Reserve in November. Keep in mind, they sell that oil, and they have taken out quite a bit, especially at the beginning of when oil prices started to climb dramatically. At some point, they have to refill the Strategic Petroleum Reserve. That said, when we are in this earning period, the expectations are that energy is going to lead. So whether we're talking about companies with natural gas, whether we're talking about oil refiners, whether we're talking about the big integrated names, the expectations are that just as in the last quarter where earnings really did well and beat all of the other sectors, that again in the third quarter earnings are going to deliver the best news for the overall third quarter earnings season. As I close this call, please keep your eye on the industrial sector. You notice that it's starting to inch higher. Pay attention. It's important because when we look for any signs of a shift in the market, we look at the very beginning to see if it's something maybe a one-off or is it steady and is it gaining. Similarly, believe it or not, in this environment, financials are also starting to see a little bit of light. Very important as we go into the earnings season of whether or not, especially after Friday's announcements, do we see the financials, still showing investor and trader interest. So this is an important week for the market, despite today being slow volume as the Treasury market is closed. When we open tomorrow, what we're going to be looking for is where are those yields? Are they still as high as they were last week? It will have an important effect on the market, as will the U.S. dollar. We'll see if the U.S. dollar weakens, pulls back a little based on where the yields are. Have a very good week. Very important. Pay attention to the guidance from the announcements that we have this week. And as we go into the rest of the earnings season, guidance is going to be probably one of the most important ingredients for this market. You know why? Because the market looks ahead, and that's what guidance is about. What are companies' clients, what are their customers saying? How do they see the next 3 months? So that's why it's increasingly important, especially when pessimism is rife. Have a good week. Don't hesitate to get in touch. I can't thank you enough for listening.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.